we live? Yep. Good afternoon, ladies and gentlemen. Thank you for joining us at this 2020 results presentation. My name's David Barrett. I'll give you a short introduction. There'll be an opportunity later on for questions and answers as questions. If you'd like to use the function, the raise hand function on this app, then we'll come back to you. Okay, so 2020 I think was a year that we'll all remember for a long time. Exceptionally challenging for many businesses, and let's not forget for many personally too. However, we adapted our working methods to make sure that we could remain open for business, delivering key infrastructure projects and maintaining employment and payments to our suppliers. I'm very proud that despite such challenging circumstances, we turned in increased revenue to £124.2 million, increased EBITDA to 23.9 million, and most importantly, a 7% growth in EPS to 4.5p. We also stayed on track with our plans. We completed the acquisition of the remaining 60% of GD Harries, the quarry business in Wales. We completed a significant debt refinancing with a syndicate of 5 UK and European banks. We improved operational gearing, and we initiated a formal sustainability programme. In December, we raised £12 million in a placing that was significantly oversubscribed. And I think that fact shows that there's a growing level of confidence and support from our existing and new investors. We made a step change in governance in the business to reflect the growing size of the business. We appointed 2 new independent non-exec directors, Jacques Empson and Simon Chisholm. We appointed Dean Macefield as our full-time CFO and appointed Anthony Brockbank, who's got huge experience in this field, as our general counsel. 2021, we continue to make good progress with the foundations of a substantial aggregates business in Belgium, Granulad Dano, and with the acquisition of 2 ready-mix concrete block businesses, which are strategically located on the Albert Canal. Max will give more details on this a bit later on. I'm going to hand you over to Max now.
Good afternoon, everybody. Thank you very much for joining this results call. For those who have the slides in front of them, we're on slide 7 now. The slides are available on our website in the results section. So on slide 7, quite an interesting year this year. We've got in the annual report a full document, a full calendar of every month, the key achievements of this year. There's quite a few that we're quite happy with. We completed a small acquisition in Belgium at the very start of the year, which is effectively our first step into the European continent, stone holdings. We did that in parts. That's one aspect of last year. We continued on that trend, even though the COVID disruptions halted for some months the progress of the business in terms of expansion and integration of the group. We pushed through a number of changes in terms of governance, as David just said. We had an additional broker, Peel Hunt, to join us next to Liberum. So again, a significant year in terms of development of the group, even though there were quite a few disruptions in terms of COVID and how COVID impacted the company. To give you a bit more clarity on how the trading went across the year, on slide 8, I'll just go platform by platform in succession of how they were effectively established. So the first platform we created was the Rhone platform in the Channel Islands. Interesting 4 different quarters. Quarter 1, very good start, good asphalt program in the Channel Islands, Jersey, Guernsey, decent pipeline of real estate and infrastructure work in general. Then the COVID lockdown started quite thoroughly down in the Channel Islands with complete lockdowns of the islands across the month of April, but no activity allowed for a large part of that time. And then easing subsequently, perhaps a bit quicker than elsewhere. So you'll see that we would have seen a significant drop in volumes and turnover for the months of April, and then May climbing out of that dip. What subsequently happened were a steady set of quarters in terms of quarter 3 and quarter 4 in terms of good volume in Jersey, with Guernsey slightly less buoyant, in part also because of elections and political change, and then subsequently Guernsey's picked up quite nicely since then. Look at the precast platform PPG. There's 3 businesses: CCP, Poundfield, and Allen Concrete. Slightly different profile, slightly slower start of the year in Poundfield, decent start in the other 2. COVID hit. As COVID hit, quite a few of the competitors shut their doors as well. Demand dropped significantly as well, of course. We were able to stay open for a number of reasons. It's not part outside manufacturing, and other part is in big factory halls, which are well ventilated, aerated, and not many people on production lines anyway, very well spaced apart. And as a consequence of that, we knew that we could effectively stay open, continue to produce during the COVID lockdown period without putting anyone at risk. So we did that, and even a dropped demand picture allowed us to still sell at a decent rate across the month of April and May. And then subsequent to that, with all the work that went on in home improvements and infrastructure projects that came on stream, the demand for the products that we make out of CCP and Allen Concrete, fence post, building blocks, and everything that goes into housing was fairly sustained right across the year, which was good. Wales, South Wales, again a different picture there. Fairly heavy lockdowns, steady demand in the beginning of the year. Fairly heavy lockdowns, which took a bit longer than elsewhere. Slower to come out of the lockdown period, and a slightly slower end of the year in terms of December, November, December months because of cycles, projects being available in that region. Decent performance nonetheless in the South Wales business, and we obviously took that business over at the end of September, beginning of October of last year, with a few months of dealing with the 2020 period at the end of last year, and then a full integration process as we started this calendar year. And then Belgium, I'll come back to the details of Belgium later, especially in terms of our evolution there. Good year in Belgium. Belgium allowed construction to stay open right across lockdowns. It wasn't too clear in the UK, but it was clear in Belgium. Cleared government instruction to keep going, and we managed to convince workforce unions and everybody in Belgium as well to keep the factories going. Again, the same logic is here: open air production, ventilated production halls, not a huge amount of people per production setup, and they could be spaced out quite nicely. And as a consequence of the lockdowns, a lot of people staying at home, the demand for garden products, landscaping products, and everything that we produce out of the Belgian setup, primarily CDH, was fairly strong, and so that business had a good year as well. In addition to the structural changes we started to put through in the beginning of the year when we took over the Belgian business. If you go on to slide 9, you will see what that effectively looks like as a sort of a turnover profile for the year 2020 versus 2019. So this is a graph we created with exactly the same businesses in exactly the same months, even though we didn't own all of these companies until 2019, to give you a like-for-like picture. And you see is decent trading in the first quarter, and a dramatic drop in April, and then a recovery subsequent. We subsequently traded ahead of the numbers for 19, like for like, and that is in part a support of the market, of course, but in part as well organic growth through better initiatives, better production, better sales networks that we started to establish across all our groups. And so as a consequence of that, quite a nice evolution in trading. And as a result, when we look at slide 10, the group has again stepped forward in terms of size and scale. There's a bit of a map there in terms of where we are active, and I'll go into the details of this a bit more further down in the slide deck later on. But we've now got 5 platforms, not 4, 2 in Belgium. I'll come to the details there. A fully established one in South Wales, with the full integration of GDH as well, and of course the existing businesses in the rest of the region. A further change we made this year is on slide 11 and then slide 12. As the group evolves and as it starts to gain more size, it was required that we address everything that has to do with ESG, so environmental, social, and governance. Particular governance is a point that we took very seriously to basically get this group to a better level or a higher level of its governance approach. That's led to a number of changes. We've changed the board completely in 2020 with 2 non-exec directors, independent non-exec directors who joined. Jacques Ebsens, who's a very well-known figure in the industrial minerals space from his history in the Spelco business, and then Simon Chisholm, who's well respected in the city in terms of investment management. So it made our board a lot more rounded, more independent directors on it, which is great. We appointed a part-time general counsel, Anthony Brockbank, partner of Phil Fisher as well, very experienced in everything that has to do with company law, and he's since then reviewed all our policies, which will be available at various places, websites, and annual reports. That puts this business again at the level of much larger peers, which is great. We've reviewed from a sustainability perspective a number of different frameworks that are out there, Russell, FTSE Russell, TCFD, and so on, so that we can start to report in terms of climate goals and in terms of emissions that the business has, and the full report is available in the annual report as well, so for you to have a look at. And then from a risk perspective, the risk section is much expanded. Charlie Trigg has taken over that area, and you can find further detail in the annual report there. The key message on this slide and of this section is where we have made another step forward in terms of how the whole governance side of things is dealt with in the business. And then a few initiatives, of course, that we are quite proud of. If you look at slide 12, from an emissions perspective, there's plenty of initiatives across the group. Probably the largest one is phase 3 of the solar panels in Belgium. We now generate a third of our electricity consumption in what is our largest operation across the group from solar power. We feed some power into the grid as well. In that same business, we also have water pumping activities, and we supply a small town worth of clean water a year through the pumping and filtration systems we have on site. Social commitments, of course, continue. We post regular updates on various social media of activities that we organize. Also in terms of diversity across the workforce, promotion of women, promotion of minorities, and so on across the workforce is starting to take shape, which we're very happy with. And then the governance commitments and the committees we've now set up, the corporate governance codes that we follow. All of that is available on the web and in our annual report. So again, not just growth by acquisition and development of the businesses, but also the governance side of things has been much a focal point this year. I'll hand you over to Dean now, who's on the phone from Jersey for the results itself. Dean?
Hi, good afternoon, everyone. If you've got the slides in front of you, I'll be on slide 14. So following on from some of the context that David and Max have given you on the results, the first slide talks about the year-on-year growth we've had in FY20. As you can see on the first block, where there's a revenue uplift this year, or the year just gone, of 77%. Now, that's up to 124.2 million. That's obviously partly due to inclusion of Carrier Duino for a full year and part of GD Harries for the last 3 months of 2020. So whilst the growth on the revenue side of things is partly due to that, obviously, it's also pleasing on a like-for-like basis that we've driven growth organically. So while some of it is with the full year of CDH and a bit of acquisition from GD Harries, there's also been good organic growth within our platforms and entities. The next slide, the next chart, sorry, you can see underlying EBITDA has gone up to 23.9 million, 64% increase. Slight, just if for those of you who have been through the full results on the RNS release this morning, slight decrease in the EBITDA margin, not much, not significant, from 20 something percent in 19 to just over 19% in 2020. But that's to be expected given the situation of the month of April with the various lockdowns, particularly in the Channel Islands, as Max referred to, which we had very, very strict lockdowns, both in Jersey and Guernsey, and especially in Guernsey, where business was pretty much ceased for everybody on the island. So we found we had a 50% drop off in revenues across the group in April. Yet despite that, we were able to remain EBITDA positive, which is pleasing. You'll see the profit before tax has increased to 12.2 million, which leads to the increase in the earnings per share, 7% up at 4.5p. If we go to the next slide, slide 15, it's a snapshot from the full financial statements within the RNS. This picks up on some of the numbers I've just alluded to on the previous slide. You can see the increase in revenue with the full year of CDH and some contribution from GD Harries. Solid growth in profit after tax and EPS, as I've just talked about. An expected increase in finance costs, given the full year inclusion of Carrier Dueno, which had some debt within it. That's been refinanced alongside the existing, at the time, the existing Sigmaroc debt. So we now have a new syndicated debt facility to bring all of the group's debt under one facility. Tax continues to be relatively low against profits, as with some group relief of tax losses carried forward, etc. And one other number just to give further explanation to on that slide, the other net gain is primarily the share of earnings from GD Harries from the time it was equity accounted as an associate, with the completion of the acquisition not happening till 21st of September, I think it was, or 22nd, I think it's 21st. Slide 16. This slide gives you an idea of the cash generation that we've had throughout 2020. We began the year with 9.9 million and ended the year with 27.4. Some of the sort of more significant movements during the year, you'll see it was circa 2 million euros, so 1.8 million sterling. Money's out for CDH, that was for farmlands for the extension project happening in CDH to extend the quarry. 7.5 million out for the GD Harries acquisitions, that was funded from our own cash. There were some deferred payments totaling 2.5 million, mainly due to the Carrier Dueno acquisition and a few other smaller items. Then the equity raise in December 20 of 12.4 million, bringing us to a healthy cash balance at the year end of 27.4 million. On the following slide, talk about some of the key balance sheet statistics. You'll see an 84% increase in tangible assets. Now that's partly due, so that increase of 65 million is partly due to the acquisition of GD Harries, whereby their assets come onto the balance sheet of the group, but more so due to a purchase price allocation exercise, which was carried out in 2020 on Carrier Dueno, which reallocated circa 40 million of goodwill on the initial acquisition, reallocated on the PPA exercise to tangible assets, demonstrating the strength of the asset backing in Carrier Dueno. Total assets increased by 49 million, which includes that increase of the cash as well as the assets brought in with GD Harries acquisition. Net debt decreased to 43.8 million, partly due to the strong cash balance, which you can see at the final block on that slide, the 27.4 million, which is a 177% increase on our cash at the beginning of the year. I think that's my final slide. Of course, if there's any questions, please feel free to ask me questions at the end. But for the time being, I'll hand you back to Max. Thank you.
Right, thank you very much, Dean. Yeah, can we all hear it? Okay. Okay, we've landed on slide 19 at the moment. There's a few slides here which are more for general information purposes as well, a bit of a summary of what's in the annual report as well. I think it would be interesting to go straight down to slide 21 and on from there. So slide 21, it's a slide we're quite proud of to put in the statements here. There's a couple of interesting statistics. Since the start of this business, which is a fairly humble start at the beginning of 2017, we've systematically grown top line, bottom line of this business, earnings per share of this business, even in fairly difficult markets such as the year past. We've managed to still grow our earnings per share by about 7%, which we're very happy about. The other point that's important is we've done so by keeping leverage steady, always below around or below the 2x mark, which were, again, something that we're very focused on. Now, the growth that we show here is obviously translates into extensions of the company itself in terms of platforms and operations. And we're on to slide 22, which has been the focus point of our activity across the last 3 or so months in terms of acquisitions and integration work. So on the slide 22, you'll find a map of Belgium, and you'll see that we have 2 platforms now. We've got a platform which is called Dimension Stone, which is the CDH business. That's the westernmost dot on the map. And then there's 4 other dots that you see, which are the Benelux Construction Materials platform. I'll give you some detail on both. First and foremost, CDH platform and what we've done there. As you remember, we bought the CDH, the Carrier business, which was a construction materials business consisting of 2 separate divisions. Dimension Stone, which is a finished good, which is a good that's applied for terraces and for infrastructure projects and for city squares. And then standard construction aggregate, which is basically a ground down and blasted rock. The second part was run under a contract with Lafarge Holcim, who had plant and machinery on our site and were taking the rock that we blasted and putting that through their processing plant and selling that into the market. At the beginning of this year, we closed a deal with them to change the operating structure slightly on site. What happened is that we've taken over from Lafarge Holcim, free of charge, their plant machinery and equipment, which you can see on slide 23 in the photograph there. It's fairly large crushing installations. What we will do is we will run these crushing installations for the next 4 years and deliver under a take-or-pay agreement crushed materials to Lafarge Holcim's commercial organization. This is actually a very good situation for us to be in, because we know that we have offset a market to sell the nearly 2 million ton of production that we make in CDH into, which is Lafarge Holcim's commercial network, while having full control of all the production activities that we've got on site. It makes our setup in Belgium a lot more efficient. We are now a 2 million ton producer in Belgium. We will make more margins and more profit on the transaction, on the whole activities there, as per the announcement. And it allows us to slowly but surely become a large-scale producer and seller of crushed stone into the Belgian market, which we were obviously not so far. So that's a very good evolution for us. And after this transaction is over, so 3.5 years from now, we will replace the existing installations that Lafarge Holcim has got on site with new crushing installations, which will be more efficient, cleaner, bigger, and we'll then start to commercialize the stone that we produce ourselves, which again will be a step change in our activities there. Now, as we were now suddenly becoming a large producer of construction materials in Belgium, not just Dimension Stone, we decided to split the platform into 2. On the one hand, Dimension Stone, on the other hand, construction materials. Dimension Stone is a very specific type of business. It's a finished good. It sells to private customers. It sells to architects. It's totally different than selling concrete or crushed stone. So we split them up into 2 parts. The second platform, which is the crushed stone platform, we then integrated into the other activities and new acquisitions that we were eyeing in Belgium, which is detailed a bit more on slide 24. So we now have a large operation producing stone in the southwest of Belgium. We have the smaller quarries, stone holdings in the east, southeast of Belgium, and we added to that 2 concrete businesses in the northeast of Belgium. That makes a nice complete whole. It's both production and consumption of aggregate. The 2 concrete businesses we bought for 13 million euro in last month are very nice operations. 250,000 meters cube of concrete produced per year, which is a nice and large volume. The businesses are located along the Albert Canal, which is a very busy shipping route linking the Scheldt River and the Meuse River in Belgium, and linking the town of Antwerp and the town of Liège, which are 2 big consumption hubs and industrial hubs. So having concrete businesses right in between those, in a very wealthy area of the country, connected by river and by canal to our other aggregates businesses, means that we can self-supply if we wish to, and we can start to really sell materials at a larger scale into these markets. So strategically, a very nice position to be in. Now, this is only a start of our Belgian platform, Benelux platform. We always seek to grow that and make further steps forward. And then the other thing that we did in the UK, more primarily on slide 25, is a new step into a new direction for us, which was becoming more of an innovative company as well. We had not innovated in product before. We've now started to do so with the launch of Greenblock. Greenblock is a first product in a series of products that we hope to commercialize and produce. This is a 100% cement-free concrete building block. It reduces embodied CO2 by more than 70%, or more than 2,500 kilos per house built, average house built. We currently have the standard dense block, which is the standard building block you would see at building sites, and the aim is to then roll this product range out over more of the different products that we produce in our portfolio. It's had a lot of success already in terms of interest and reception from customers, and it will, as the year progresses, start to make its way into big projects, specifier projects as well. So if we then go to the last slide of the presentation I've got here, if we go for the outlook for this year, so Q1 2021 is much in line with what we expected. We raised some funding at the beginning of last year, at the end of last year, to do some acquisitions in Belgium and in the UK. That funding was deployed in Q1 as we indicated. We think quite nice transactions as well. Trading across all platforms is good as expected. It's in line with the budgets that we've got and the targets we have for this year. And that in spite of a lockdown in Guernsey, which was quite strict, quite bad weather with snow in Belgium, snow in the UK, some heavy rains as well. So all of that meant that there were some disruptions, but we caught up for that. The half-year outlook for the first half looks pretty good as well. The trends that we've got look to be sustainable for the next 3 months as well. What the second half of the year looks like, we will reassess a bit later. It's got to do with what do lockdowns do? Are lockdowns coming back? Are they not coming back? Are economies being allowed to operate more normally? All these things will impact what's going on. Investment and growth, we're targeting quite a few of those as we keep going. Quite a few organic projects we're looking at, especially around our UK operations. We've got already a decent footprint there, and growing those footprints would be quite advantageous for us. Same also as well with some of the Belgian operations. And then we look to see if we can innovate or continue to innovate in terms of and increase the portfolio of innovative products that we make. Greenblock was only a start. We're looking at quite a few other ideas as well at the moment. So that sort of wraps up the slide presentation that we had for this meeting. We're happy to take any questions from all of you on the phones. There's a raise hand function in the app, so if you could use that, then we can answer your questions.
So I've got a question here about Greenblock. Can you read this? So can you tell us more about Greenblock? What are your expectations re its effect on the future financial performance of the business?
Yep. Okay. So Green Block is the result of about 18 months of work, of testing work and development work in the CCP business and PPG arm of the group. The aim was, can we make a building block, which is the most standard used, most commonly used block for building houses and infrastructure. The first and first target was the dense 100 mil block, because that's, it's a fairly well used block, especially for foundation work and so on. Try to see if we could get that to a point where there was no cement involved in it. We got that done. Now that block is now launched and is starting to make its way into specified projects. So that's usually the route, especially when you have new products in our sector. It is when big developers and architects start to specify a product into development work that then gets signed off and commissioned, that this product starts to make its route into the market. So we launched it on purpose earlier this year so that we have plenty of time to get attention of architects, developers, get specified into projects, and then move on from there. That's sort of the space where we are at the moment. We will be able to give you a better indication of financial impact across the group later in the year, but it looks extremely promising in terms of that specific block already, and especially if we then also start to add on to that other products that come out of the CCP and PPG factories in general, where we have a more broad range of green products. We'll have quite a nice sort of range of low carbon alternatives for people to use. I expect that if this all goes to plan, that a significant proportion of our block production across the PPG business will start to move over from cement containing to non-cement or non-cement based blocks over the course of the next months and years.
We have some questions in the Q&A.
Yeah.
Maybe you want to solve first. Bluestone, what's the competitive landscape like?
Bluestone is an interesting one. We've got a really good position competitively in terms of bluestone in Belgium. We are the largest producer of bluestone worldwide, and there's only 2 other producers of this type of bluestone in Belgium, and one other one in Europe that produces something that is similar in terms of color, not in terms of chemistry or in terms of performance. Bluestone competes therefore with effectively 2 other suppliers. If you consider bluestone as a alternative to any dimension stone you could get, and you start to include into that the white marbles out of Italy or Spain, or the marbles of all sorts of colors out of that part of the world, that's obviously then you've got a much broader competitive landscape. Where bluestone is quite nice is that its primary applications are for outside, so terraces, city squares, infrastructure work, cladding of buildings. Both color and performance of the stone make it quite unique, quite durable. So if you go to Belgium, Benelux, North Germany, North France, for buildings of 150 years old that are made out of bluestone, sometimes even bluestone that came out of the quarries that we now own, that still look extremely good. Didn't require a huge amount of renovation work to stay in that shape. So that's the unique feature that bluestone has. It ages very well and it stays very nice. So from a competitive perspective, as a dimension stone outside, it's a great alternative. What we also in current trends of ESG and climate consciousness, bluestone is a lot better in terms of ESG and environmental impact than, for instance, a ceramic or a composite material. It's the CO2 impact of quarrying the material is low compared to what you would have with materials that have a lot of heat required in the manufacturing process, like ceramics would have or composites would have. So from that perspective, I think it has quite a nice future as well.
So we've got 2 more questions on Green Block.
Yeah.
How have the large national house builders reacted to the introduction? And is there any patent or IP associated with Green Block? Okay,
so the large house builders have all reacted with very much interest. And again, as I said before, any product that large house builders would use in their large developments are obviously specified project. So they They would look at a new housing development of any X many units that will be built in the future. They would now start to specify the green block in there as a material to be used. So the enthusiasm there has been very, very, very high, which is understandable because it was somewhat needed to have a low carbon alternative for dense concrete blocks in this market. The uptake of the block in terms of production, absorption in there, and production and in terms of use will then, as these specified projects come out, will then start to go up quite significantly, we expect. So house builders have been very, very, very keen on this.
The second lot, that was about the IP.
Ah, yes, the IP. There is IP lodged into the secret sauce, if you will, in terms of how you make a concrete block without cement. Cement has always been the binder that was the go-to binder, and that since Roman times. If you change that cement binder out, you change it for a different binder. There's a specific IP within that. That IP is both in terms of blended products and in terms of products used. There's a few alternatives that can be used. We're working together with people that will help us with Greenblock on this particular product. And there's alternative routes for different materials as well to get to the same result. Greenblock and this product is the best material available to our knowledge at the moment for this application.
And one more question. Can you tell us any more on whether you have any acquisitions in the pipeline for this financial year? How close are you to end?
Okay, so we've done already 2 acquisitions this in the first quarter. We did the deal with Holcim, that's probably a third. There's a whole bunch of organic development of the group that we announced at the end of last year that we're going to push through. Once that's all lined up, we're continuing with the pipeline that we've got. At any point in time, as I always said in previous calls, and it's roughly the same at the moment, we always have 6 or 7 transactions at different stages of advancement at any point in time. Which one we go for and when we go for them is entirely dependent on price point and quality of the business. If we don't find or feel that the price that we will have to pay to get a business is the right one, we won't go for it. And we're very happy to just wait or let that deal go. The most important thing is buying the right company at the right price. If you bought it too expensive, you will never recover or make that good. Or certainly not in the short term. So yes, there's plenty of work that we're doing. There's plenty of business that we're looking at. There's plenty of projects on the go. And as they get a bit closer to where they need to be, we'll come out with the announcements.
So, got one raised hand here. Somewhere? No? Okay, no raised hand apparently.
Okay, there's a question coming by email.
Yeah.
The first part of the question is, will you start to see ex-working capital free cash flow conversion of EBITDA improve? Should we direct that one at Dean?
Yep.
David, can you, sorry, just repeat that? I just missed a bit of the question.
Will you start to see ex-working capital free cash flow conversion of EBITDA improve?
Yes, I think that's fair to say. We quite often, depending on the type of business we acquire, a lot of these family type businesses, sometimes the working capital needs improving, or there's sort of improvements, efficiencies we can make in that. So yes, as the business has become, for want of a better phrase, more mature to the SigmaRoc group, we see improvements on the cash flow, the free cash flow. The best example of that is Rhone, when you see the contributions we get from Rhone from a cash perspective, and as the businesses are integrated properly within the SigmaRoc group, and we improve the various efficiencies we can see, operational efficiencies, improve working capital, data collection. Yeah, it's fair to say that we should see improvements in that side of things. Yeah.
There's perhaps an addition to that question as well, Dean, as we discussed yesterday. If you take 19 versus 20, There's quite a bit of improvement in terms of working capital as well. Already, you can look at the cash flow statement. You can see how debtors and creditors have evolved over time.
Indeed.
Sorry, jump forward.
Yeah, that's a good point. That demonstrates if you look at the full financial statements in the cash flow statement, you'll see an improvement in the working capital situation, and that kind of highlights where we improve some of the businesses that we may have only sort of acquired in the last year or two prior to that. But as we go through the first 1 to 3 years, you see the improvement coming through in the cash flow. So yeah. And
that's explained how across the year, even where there's COVID, there's quite a bit of impact in terms of lost trading across May and sort of April and May months. The cash generation across the group was still significant, so significant that we could purchase the rest of GDH, significant amounts of land which we needed for the extension in Belgium, as well as the deferred consideration we had to pay for the Belgian acquisitions. All of that was paid for from cash generated internally. Now, as we paid for all of those items, we ended up at the end of the year having done quite a few bits of work there. So the stone holding at the beginning of the year, the land for consideration, GDH, we knew that we could now utilize a bit of an opportunity in the window there to purchase these two concrete businesses in Belgium at a good multiple, 4 times multiple, not even 4 times multiple. We needed funding to do that, so obviously then we went for a capital raise at the end of last year. But that was entirely based on how that pipeline had evolved and the opportunity we saw. We thought, okay, this is the right time. Let's bounce on this before it's gone.
That actually goes part way to answering another question, which is, will you need to continue raising equity, or will your free cash flow generation be enough to continue doing M&A? So Max has partly answered that. Yes, we've got a decent free cash flow now, which we can self-fund acquisitions of a certain size. We may or may not need to look for further equity, depending on the size of future acquisitions.
Yeah. In addition to that point from David, actually, if you can find, take the example of 2 concrete businesses in Belgium. So they're located along the Albert Canal, which is a stretch of canal which is finite in terms of size and in terms of locations available along that canal to operate concrete businesses along. One of them, B-Mix, is located on a plot of land of 11 hectares. As you would have seen in the announcement, we've got the possibility to purchase that land for a fixed price. If you go around the area there and you look at what other transactions have been in the past for that land, you will see for land there, you will see that the price per square meter is significantly higher than what we are paying for the square meterage of the land that we can purchase. It's so much so even that the 4 hectares of the 11 that the concrete business operates on would effectively come for free, if you will, were we to sell the remaining 7 of the 11 hectares. Now, that land holding we can do plenty of things with as well, if we wanted to build up further businesses or other activities in Belgium, maybe a trading hub for aggregates, who knows. But the point here is, and to the question of that David just answered, if such opportunities come about where you can purchase a very profitable concrete business at 4 times multiple, get land holdings with it, which you can purchase for a price significantly below market price, which on top of that, where you do not sell it, can deliver additional space to do other activities on. These things are really worth purchasing because they increase EPS and they increase earnings per share and ultimately share price. And that's the whole point here. So if that happens and there's a slight imbalance in terms of cash flows and cash generated, because we've just done another few acquisitions and said, oh, this is really worth having in the group because it makes the group a lot bigger, better, and more valuable, then from an earnings maximization and from a shareholder value maximization perspective, it is then the right decision to say, we're not waiting, we're going to shareholders, we're asking for a bit of money to do this because it will help us in the future, depending on timeline. Otherwise, we have, for smaller deals and smaller sort of continuation and development of the group, we've got the internal resources to continue to do that.
Okay, another question is, are your non-underlying expenses going to fall as a total amount? Well, if we did no further M&A activity, they would definitely fall, because most of the underlying expenses are fees for raises and for advisors in acquisitions. So it really depends on what our M&A level is in the future.
There's another point on the non-underlying expenses. There's a number of expenses in there which are non-cash. It's actually quite a large proportion of the total quantum. They're non-cash, effectively consequences of accounting rules, and they're consequences of reevaluations that have to be done across the group. And when you purchase an asset, you have to do purchase price allocation exercises that then generate essentially amortization figures that are consequences of that. They're non-cash items, and so we structure them, as do others in the industry. We structure them as part of the non-underlying cost. There's another point in the non-underlying items, for instance, which is sometimes people miss or have not seen. When we do large transactions, we did this with Rhône, we did this with Belgium. We've in the past twice used warranty and indemnity insurance. So when you buy a business, there's always warranties and indemnities, and to make sure that you're well covered for any risk that you have with that acquisition, you apply insurance on that. That's very much often dictated to us by the sellers. It's actually beneficial for both sides, for them and for us, because it's sort of it's a policy which basically protects both sides. Now that cost obviously is a consequence of a transaction that would be sitting in there. We would have not normally had that in the underlying trading of the business. So it's such items that are in there more than anything else.
Okay, I think
There's one more question I had from email as well. Margin, work on margins. Email questions. What are you planning to do to improve margins as per the second half of last year? So the underlying margins of the business itself is pretty solid, and the various existing businesses are pretty solid. What we have done is, and that was with CCP the case, and it's the case with GEH as well, is we add onto our group businesses that have EBITDA margins which are slightly lower than our group average. That in the short term, what that does, it drops the overall average of the group. And as we then start to improve those businesses and work through various initiatives to make them run better, these margins should with time improve, and that helps that margin back up again. You will have seen that fluctuation in 18-19 where it went down a bit, and then now, and as we then work on the various companies, that will steadily improve again.
okay, I think Dean's had a question in about a provision on the balance sheet. Dean, would you like to take that one, please?
Sure, yep. So there's about 6 million provision on the balance sheet. That's made up of a number of items. So there's sort of more significant items. There's some small restoration provisions for some of our quarries. It's sometimes a condition to build in a provision for the costs of restoring the quarry at a discounted value, restoring the quarry to its natural state or to a certain state. That obviously is, again, following from back to about accounting entries, it's a necessary provision, but that could be 30, 40, 50, 60 years in the future. But that's a smaller part of it. I think the restoration provisions across that 6 million are probably less than 800,000 of it. The bigger provisions, there's a loss provision on the Holcim contract, which was built in when we set up the contract, when we acquired a CDH, so that's releasing every month. The biggest part of the provision is within Belgium. There's an early retirement actuarial calculation that has to be done. They have, under Belgian law, employment law, they're allowed to retire early if certain conditions are met. So there's an actuarial calculation. It's kind of a deferred benefit pension type calculation. So again, to some extent, it's an accounting entry. Nevertheless, under IFRS, it needs to be recorded. It's an early retirement provision. Whether it gets realised, it changes every year due to actuarial calculations. And if you've ever delved too deeply into those, you will know what they're like. So that's the bulk of the provision.
I had one more question here on email as well, which is related party payments to directors and what they consist of and how they work. So there's effectively primarily one, which is the fees we've got in the group to the accounting firm that prepares the accounts from a regulatory perspective for listed companies, which is Heytesbury. Garth Palmer, who is our non-executive director on our board, is also director of that business. It's been we have had the relationship with Heytesbury for a number of years. They've done an exceptional job for the company in terms of preparation of accounts, preparation of annual reports, help with all that, all the regulatory and the company secretarial work that needs to be done. Again, for instance, the annual report that's come out now has been prepared with a lot of help from them. So we're very happy that we've had their support over the last years to publish quality information, and that's primary payment. It's primarily a function of Garth being a director of both businesses. Was there another question?
That's all I got. Anything there?
There's two more in the Q&A. One, what's your understanding of brokers' forecasts for 2021?
Broker forecast for 2021. So there's two notes that have been released, if I'm correct, or two updates that have been released from Liberum and from Peel Hunt. They're short sort of summaries in relation to our results, and the larger notes, longer notes that will, if I understand correctly, will be released later on in the month. Both, as far as I have the detail, have increased the forecast for our numbers for 21 versus what they had in there before, in relation to performance of 2020, in relation to the acquisitions we've done. So in each case, our EPS targets have been moved up.
Yeah, the consensus is around about 5p per share for 21.
So what are your thoughts on the land you have under option in the latest deal?
So the thoughts so far are that we've just taken over the concrete business, and we're now going to have a good look at what we can do with that land, whether we take it in whole, whether we take it in parts, whether we keep a bit, we sell a bit, we don't know yet. The option runs till the end of March next year. And so between now and March next year, we'll have a good plan with it. The reassuring bit of that land is the purchase price, as it stands currently, obviously with current values, is such that we, if we were to sell the superfluous land, we'll do a good job on that. We can make that at least break even. Nobody knows how land prices will evolve. They can go up, they can go down. But from that perspective, it's pretty good.
Independent valuations show there's good value in that call option.
So that's helpful. So we were very happy to go into that call option because of that. And we're now looking at what business opportunities we can put there. But of course, you've got a concrete business there, so perhaps logical to look at what else you could do out of a site that already does concrete.
So last question, have you got any intentions, short or long term, to move from the company listing? Move the company listing from AIM?
Not something that we've thought about just yet. And I suspect the question is in relation to moving it away from AIM to the main list, maybe. We haven't thought about that in much detail. We've got Anthony Brockbank here as a general counsel. He's got lots of experience with that sort of thing. Moving up from AIM to the main list is an expensive exercise. Costs a bit of money. So to do that, we need to have a real clear purpose why that is, why that's the right next move. So it's not something we consider a whole lot just yet. AIM seems to have seems to work well for us so far, in terms of the market for us to operate in. So far it seems to be the right home for us. We'll review that later on.
Well, that's it in terms of questions.
That's excellent. Well, we'll have to close this meeting here because we've got the next meeting coming up at the top of the hour. So I thank you all very much for for attending this call. I hope it was helpful. I hope we managed to answer the various questions you had. I believe there's a recording of this that will be made available on the website as well for those who want to listen to it again. And then hopefully see you soon at our next earnings call.
Thank you very much.
Thank you.